Hey, welcome back, everybody, to the Four Stars Today's Market Explained video and podcast series. We're doing a market commentary episode today, and I am Brian Kasal. I'm your host, and welcome everybody to the new episode. We have Chris Reardon, who's with us here, and Chris, welcome to the podcast.
Thanks, Brian. Good afternoon, everyone, and glad to be on and talk a little bit about the markets.
Excellent. Lots to talk about today, Chris. And Chris, of course, is our Director of Development at Four Star. He's a master of all things portfolio, and he is with us here. We are operating remotely today, interestingly enough. So you're coming in from Frankfort, Illinois. Is that right?
Yep. Yeah. This kind of southwest suburbs.
And I'm up in Lincoln Park today. As I said, I'm Brian Kasal. I'm the CEO and founder of Four Star. I am advisor to CEOs, trustee of the National Foundation of the Boy Scouts, and I'm the husband to Tripty, the amazing Tripty, and dad to Evan and Quinn. And that's the players today: Brian Kasal, Chris Reardon. We're going to talk a little bit about what's going on in the financial markets, and then what we talk about the economy and how it affects that. Something a little bit about politics, which is affecting the world right now. It affects the economy. And then, of course, what we see out there in general, a lot of things that are really interesting going on right now. So our market and analyst is Chris Reardon. Chris, you want to kind of give us an update on what's working now and what's not in the financial markets?
Yep. No changes as far as kind of sorting, if you will, or rankings. So we still have domestic equities as the number one position, but we actually saw it come back 5 points from the last podcast. So it's at 256 now. And international equities is still holding that number two position, and it's -1 at 250 from the last podcast. Commodities is at 246 in the third position, +3 from the last podcast. Cash is in fourth at 148, +3 from the last podcast. Currencies is -1 at 100 in fifth. And last but not least, fixed income is -1 since the last podcast. It's at 81. So, really what we're seeing is just kind of almost a tie, if you will, on those top three asset classes. And they continue to kind of tighten and move towards each other. So we really could see any one of those take the number one position, in the matter of a week. It's just a matter of which way the markets seem to move. So we'll kind of see how they continue. The trends have been domestic equities and international equities pulling back. We have seen commodities moving forward, but it will be interesting. We've seen oil in the last week or so take a little bit of a pullback. So we'll see if that does it, over the next week affects the commodities ranking.
So this is a bull market strategy right now. So we're actually in a bull market. However, short run where the market's down for the third quarter. And then the last week or so has been kind of sloppy and messy. And we're seeing it a little bit more today. But so Chris, these three, domestic equities, international equities, and commodities, are all within 10 points of each other at the top.
Correct. Yep. Yeah. And then, so we see the aggressive, like you were saying, kind of the aggressive asset classes, almost in a tie at the top or within arm's reach of each other. And the conservative asset classes, cash, currencies, and fixed income, almost all of them are almost 100 points away in the bottom.
Yeah. So then all the scaredy cat asset classes, cash, currencies, bonds, they're way down. And then bonds are getting more and more. They're the bottom because of interest rates rising, and they're going lower. And interest rates are expected to rise again next month. And so the bonds have been terrible. The worst bond market in American history last year, and it's gotten worse this year. And that's just a reflection of interest rates going up. So at this point, it's pretty much anybody's guess which one of the top three will emerge as the leader. If we have, like last year, commodities, Chris, came back out with oil and grains, and then later in the year, precious metals. And then oil was strong again. Now it's fading a bit, but it's still, commodities is moving up technically, and the others are pulling back a little bit. So if that little mini trend holds, commodities will be in the lead again, like it was last year. And this very strange, unusual circumstance for that to be happening. Yeah.
Yeah. And, I think commodities, the big driver recently has been oil. But the very recent pullback we've seen, or slight pullbacks, have been mostly due to concerns over waning demand if we are going to go into a recession or something like that, or the world is, obviously that would crimp the demand for oil. There'd be less products being shipped. People would be traveling less, things like that. So, who knows what will happen? Mostly consumer spending has held up, but people are speculating, if you will, at least in the short term, of what will happen.
Yeah, that's right. Well, and it's a strange circumstance, as I said. Now, if commodities are in the lead, then the commodities, obviously those are input costs to business. So commodities are in the lead for a long time. That's probably not a good thing for a lot of businesses because they're input costs. Commodities were leading for a good part of the time last year, and if they lead again, that's signaling recession at some point. This domestic equities and the growth side of the market, which should be better. International has led most of this year, but now domestic had rallied. Now they're both fading a little bit here. So it's really interesting to see all the twists and the turns that go on. But cash is actually acting a little bit better too, Chris, meaning that's just a sign that people are playing a little bit out of stocks and into cash.
Yep. Yeah. I mean, I think cash is the one for us to keep an eye on because if we continue to see, let's say, us move towards a recession or the world move towards a recession, we'll most likely see commodities come out of favor as well, just because that'll usually, be less spending, and less spending means less building, things like that, less use of commodities.
Sure.
So cash would be the one to keep an eye on, and it could pick up that pace very quickly. But for right now, it's almost been a tie in those top three. They've kind of just held steady, even though we've had some volatility in the financial markets, at least in the last week or two.
Yes. Well, and so then we open the fourth quarter here, Chris. We're taping on October 6th. So this is Friday of the first week of October and the first week of the quarter. And we saw the third quarter show a very negative move. I think about 4% in the indexes downward. And it was the first negative quarter since the fourth quarter last year. So markets kind of took a breather. Then we had a really bad day on October 3rd this week. And so now sometimes the way the markets position things, what's good is bad and what's bad is good. So then we saw the employment numbers come out stronger than expected. And that's before revisions now. For full disclosure, most of the employment numbers we've seen that were good have been revised down, in a couple of cases way down. So again, here we are seeing another really decent employment number that I suspect will be revised downward when they come up with all the different revisions. But in the short run, the market says employment meaning good. The economy is not slowing down. That's going to cause inflation. So then the market goes down and interest rates go up to attempt to slow down the economy. So the economy is moving too fast, according to the Fed. The reason the Fed is doing this is because of inflation. Inflation will kill the economy eventually. So they're trying to kill inflation before inflation kills the economy.
Mm-hmm. Yeah, and I mean, I think the other major factor, which kind of feeds off of that strong jobs number, has been consumer spending has remained relatively strong in the U.S. Over the last couple months. The readings we've gotten from August so far have shown strong trends there. So I think what this is pointing to is a very a lot of pressure now. There's a lot of eyes on kind of the holiday season coming up. And whether that's going to be strong, whether we're going to see a lot of sales. The expectations, I think, are pretty low, but we'll just have to kind of wait and see. So that'll be, interesting. And then I think the other factor, and we've talked about it on here, is, if consumer spending is holding up, is it good consumer spending? Are people overspending and piling up debt, which is a trend we've seen? And if that's the case, if people are just spending and increasing debt, that's kind of building a weak foundation. So eventually that's going to come toppling down. So just a lot of interesting things building. So we'll just have to kind of wait and see, what comes over the next couple months.
Yes. And then this week revealed a gentleman who everyone who watches CNBC knows, Rick Santelli, who is a financial reporter for CNBC, revealed his view of a catastrophic scenario where interest rates go to as much as 13%. Anybody who was around in the early 80s and late 70s remembers we did see those kinds of things happen. Inflation was out of control in the 70s. And basically it took the Paul Volcker-led Federal Reserve almost 3 years to get get inflation back down. So they had a disinflationary period kind of in 83 through 86. And so it took a long time to get the inflation down. So if that scenario were to play out, and it's kind of a horrific scenario, that would basically mean that all the things the Federal Reserve is trying to do right now, lowering interest rates, would not have worked, basically. So the Fed's tools failed in the short run. Now, eventually they will succeed, but eventually it could be 3 years, right? That's what happened in the early 1980s. So the Federal Reserve only has certain tools that can change reserve requirements. They can raise short-term rates that can't really affect long-term rates, but they can raise short-term rates. And they can also put money in the system through quantitative easing. And so those are the tools they have. But if they pull all those levers to try to get rid of inflation and it doesn't work, then we can see runaway inflation. And that's what Rick Santilli was talking about. And interest rates would go, he's saying up to 13%. We're at 7% on mortgages now. We're at 5% on money markets and 5% Fed funds rates. So hopefully it doesn't happen, Chris. But that scared the markets a little bit on October 3rd when we had that bad day, when that whole view was revealed. But that's that's the one scenario that could play out. Hopefully not. But and then that would signal inflation at least for a number of more years.
Yeah. I mean, and I think it's important to point out, if that scenario plays out, it will, choke off a little bit of the economy. So it will probably have a significant impact on the overall economy as well. Obviously, lending, credit card debt, mortgages will go up even more. So that would be a hard scenario on the U.S. economy, but we'll see. I think the one thing that people are factoring in is, yes, we need to crush inflation, but what we've seen out of the Fed is the last couple of years is the Fed is more political in a certain way. And so, if we see the markets getting crushed, kind of like we saw in Q4 2018, at what point will the Fed relent? So it's going to be interesting to kind of see. I think we're in a little bit of an unknown kind of climate right now. So I think it's almost you just kind of have to wait and see what the readings are and what the Fed does to kind of get a better gauge.
Yes. Well, I think they're doing the best they can at this point. So we'll see how things shake out. So, Chris, turning to the economy, there's a lot going on. We're seeing strikes everywhere. I know you've got a number of things you wanted to share with us on the economy.
Yep. So, like you reported, we got the jobless claim numbers. They came out. They increased by 7,000 month over month to 207,000, which is fairly, standard. That's not a major number. I think that came in much better than a lot of economists were expecting. And once again, that was one of the reasons we've seen the markets this week have been, for the most part, down because even though that's good news that we have a strong economy or a strong job market, what that points to is if the market's still holding up, if jobs market's still holding up, the Fed is more likely to raise at the next meeting or the November meeting. So that, great jobs number. We're still seeing pretty good, pretty robust jobs market right now. And then consumer spending. So Americans spent 5.8% more this August than the year prior. So than August 2022. And the big winners, and we've talked a little bit about this, but are the experience economy. Delta Airlines reported record profits this past quarter. And then Ticketmaster, which sells tickets to concerts and other shows, sold over 295 million event tickets in the first 6 months of 2023. And that was up 18% from the year prior. So, I think we're still seeing a lot of release, if you will, from kind of this pent up energy from COVID. People are traveling a lot. We're seeing a lot of people taking trips to Europe this year, a lot of concerts. The Taylor Swift concert, I know people have talked about. Even the Fed said that was impacting inflation because tickets were getting so expensive. So, we're really seeing not only Americans and consumers spending, but they're spending more in very specific areas. Then the online sales, a new survey came out for online sales, and they're expected to grow 4.8% during the Q4 holiday season. So it'll be interesting. I mean, that doesn't mean all sales. It just means online sales. So people will be spending more money online, which has been a growing trend as is. But still overall a good sign. I think next week That's once again, we're taping this October 6th, is I think Amazon's Prime Day when they do kind of their Black Friday sales. So we're definitely going to see, that trend most likely continue. And then in the housing market, existing home sales decreased 0.7% in August from July. So that slowing is now to the lowest level since January. And year over year numbers in August, it's down 15.3% year over year, August 2023 from August 2022. So we continue to see existing home sales decline. We're seeing less volume going on in the real estate market. Home sales in general have tumbled 36% from January 2022. So in about coming up on 2 years, a little over a year and a half, we've seen home sales tumble 36%, which is quite dramatic there. So, I mean, we're talking millions and millions of home sales that have just kind of come off the market. And on the flip side of that, the national median home price rose 3.9% in August from a year earlier. So we're really seeing this, and we've talked a little bit about it. This supply and demand hasn't relented yet. So we're still seeing an undersupply. We're seeing less home sales, less houses on the market on the real estate side. And we're still seeing the demand has stayed relatively the same. So what that has done is we saw a little dip in house prices for a couple months, but now we're starting to see them stabilize and tick back up. So we still have a major supply and demand issue from the domestic real estate market, I should say. And then the next couple of things I'll talk about, the US dollar we've seen is on a tear again. It's up 3% versus other currencies. Most of this is due to the fact that at this point, I mean, if we go back to the spring, I think there was an expectation that we would see the Fed start to lower rates even potentially by fourth quarter. And now that we're the conversation is more, we may even see them raise rates again in the fourth quarter. We're seeing that strength in the dollar. So we're seeing the dollar move and strengthen again. When the dollar does strengthen, usually we see precious metals, gold and silver, kind of move in the opposite direction. So we're seeing a pullback in gold. It's falling. So gold is down 5.24% in the last 3 months, and silver is down 10%. So, we continue to see those precious metals as the dollar continues to strengthen. So, and the other thing we talked a little bit about is oil prices. So oil prices dropped. The West Texas Intermediate's now down to about $83 a barrel. Brent crude's down to about 85. And, we were just talking maybe a week or two ago about, $100 barrels of oil. So that's a pretty dramatic fallback. And on Wednesday of last week, I believe, Wednesday, October 4th, this week, we saw the single largest drop in over a year. It was $5, a $5 drop per barrel in oil prices. So we continue to see some volatility in the oil markets, and it's a very much this tug of war going on. I mean, you have the OPEC plus kind of crimping supply, but then you also have demand and the expectation of maybe a diminished demand if we have a recession or if things happen. And then the last thing I'll touch upon is in kind of the grains market. So Ukraine now is in a dispute. We've talked at length about Ukraine and getting kind of the grains out of there. They had a deal with Russia to export through their ports. And that's kind of been a back and forth battle, if you will. But now there's a dispute between some of their neighboring countries, most notably Poland, over grain exports. So Poland and other neighboring countries are restricting Ukrainian grain imports for them because they want to help bolster domestic farmers. The Ukrainians have put their grain on the market for much less because obviously they really want to get rid of it. They are motivated to get rid of it and get cash in. So that's caused an issue. And right now, during this kind of discussion and negotiations, Poland has agreed to, or has said it will stop providing military weapons aid to Ukraine. So it could have a big impact, obviously, over there. And it's going to have an impact on the grains market in general, because Poland was a big avenue for Ukraine to export their grain. So a lot going on.
Yeah, very interesting. And that's all war-driven stuff, Chris. And battles, that's really not economics. It's just things that happen because of the war. I think the most interesting thing is that the house prices keep rising, Chris, with this big slowdown in home sales. So that's just a reflection that there's very little inventory. Now, that's also a reflection of the fact that we went through from 2005 to 2012, the worst bear market in real estate. So very little development was done during that period of time. And so we're estimating anywhere from 5 to 10 million housing units light in America. And the developers are going crazy and building and building and building. Now they're going to have to slow down on some of that because there's just not as much buying activity with interest rates as high as they are. But the home building stocks were some of the best stocks this year because of that activity. And, eventually, once we normalize this level of higher interest rates in the economy and people get used to it, then home sales will come back to life. But eventually, you would think that home prices would start to go down if activity slowed down. But if you look at the kind of classic supply demand graph, yeah, the supply is still very, very tight, even though activity has slowed. So demand has slowed, but so has supply. So the both graphs shifted, and we're still seeing prices remain high at lower levels of activity. So it's quite interesting if you're into economics and studying those phenomena. How can house prices be going up when activity is falling off the end of the cliff? Well, that's why, because there's very little supply, and they really need to build more homes, but it's going to slow down for a little bit. So, very interesting stuff, Chris. And it's mostly signaling a recession. The question is, how bad does the recession get? We talked about the grains. We're seeing a lot of other kind of network effects to all the other issues of inflation happening in the economy. And there's some other big strikes out there now too, Chris, aren't there?
Yeah. So we talked, I think, notably on the last podcast about the United Auto Workers strike. And that was at three major manufacturing plants, Ford, GM, and Stellantis. So that continues, I believe, I think it's Ford. They're getting a little closer. But as it continues to drag on, it's definitely going to cause disruptions in the auto market. And once again, we're going to see more, as it drags on, we're going to see less supply of cars. And so what that could do is we could see kind of like we saw a year or two ago, we could see car prices rise because there's less supply. Assuming the demand stays relatively the same, we're going to see prices rise a little bit per car. So that does potentially have an impact on the overall market. And then I think more notably, and it's a little more recent, is Kaiser Permanente, one of the huge healthcare providers in the country, had a 75,000 employees strike just this week after failed negotiations that were very close. It's actually, as of now, the largest strike in the U.S. healthcare kind of industry to date. I believe that the promising aspect of that is that they are, I think, much closer in as far as terms. So I don't know that strike will go on quite as long as the auto workers, who are, from my understanding, there's quite a gap between what the union wants and what the companies are willing to provide. So I would assume right now that Kaiser Permanente strike will resolve itself fairly soon. But definitely, has the potential to cause major impacts on inflation, on the healthcare system, and on the auto industry.
Yeah, it does seem like they're getting closer on the healthcare Kaiser Permanente, but the United Auto Workers has a new set of leadership that is very, very labor oriented and somewhat socialist, and so it seems almost partially political. We're out there, protesting and almost a pitchfork and kerosene torch crowd. It seems very very radical. So we'll see what ends up happening there. But Chris, a lot of labor groups are upset because inflation is hurting their people. So they're not getting the wage increases to keep pace with inflation. Inflation was up to as high as 9% in the summer of 2022, and it had been on a steady trend downward, which is a good thing up until about 2 months ago. And we've seen inflation start to come back. And that's exactly what happened in the 70s, where it dipped and then it started to go back up again. So hopefully we can do as they said in the 1960s or 70s, when President Nixon talked about whipping inflation now. And then, of course, Gerald Ford, Ronald Reagan were presidents after that. So that was all about whipping inflation. And hopefully we can solve that. bugaboo and not have inflation tearing our economy apart, forever. So
Yep. Yeah, I mean, and you also see this. It's much more common. You see these larger union strikes when you have a strong jobs market, and I think we're potentially, if we do have a recession coming, nearing the end of a strong jobs market. So I think the unions are trying to take advantage while they may still have an upper hand, if you will, with their employers and the companies. But I also think, what's interesting is if we do have a recession coming, a lot of economists have noted that, we have the baby boomer generation that's entering kind of the retirement phase and phasing out. And it was a very, very large generation. So we could have this, interesting market, if you will, where we're in recession, but the jobs market is still relatively strong just due to an undersupply, because you have all these baby boomers retiring out of the jobs market. So, it's going to be very interesting. And if we do have a potential recession, it might look very different from everyone's, thoughts on, an 08, 09 type of recession.
well, and then the other big trend as far as the job market, and we'll see how that affects the economy, is the Biden administration has basically opened the borders. They keep saying the borders are closed, and they're obviously not. And so they brought in as many as 20 million people, or undocumented, as they call them. And yet there are still people going through the normal immigration process, but then people otherwise are just pouring over the border. And members of Congress and others are trying to solve that now and get a hold of that issue. But we have all these people that have come into the economy. So unless future administrations deport a lot of those people, as the Obama administration had done, then those people might be here to stay. What will that do to the labor markets? That could also keep a lid on wages. So if there's so many more people willing to work, then that's going to suppress wages, and that's going to cause more labor strife, if you will, and
Mm-hmm.
possibly strikes, right?
Yep. Yep.
More people are vying for those jobs.
Yep, that's exactly right. I mean, then we'd see a big surplus, or a big from a supply and demand perspective, we'd see more supply enter the market there, and that would certainly push wages down from that perspective.
Exactly. Well, then a lot of the top strategists are weighing in on the economy, and many are predicting a mild recession. And then there are a few that are saying that it's going to be much more severe than we originally thought. Mike Wilson at Morgan Stanley says the consumer is falling off the end of the cliff. Now we see the consumer still holding in there reasonably well, but maybe it has to do with the fact that they're adding credit card debt to keep that consumer game going. And as you said, that could very much end badly.
Mm-hmm.
So, and that's typical, of the beginning of a recession, is people try to continue their spending, and they may run up credit card balances, and then they end up having to slow down and pay off those credit card balances. So that's the same kind of stuff we're seeing right now. So, it's really at this point, depending on all the factors, they call economics the dismal science, because there's so many factors that no one can really, with accuracy, predict exactly what's going to happen. So we could see those factors really pulling the economy way back, as far as, and then what would that do to the markets and everything? Or we could see a mild recession, which has been expected, because we're seeing travel still doing well, house developers still doing well, restaurants still doing well, certain consumer. So we could see a mild recession. So if we have a mild recession, then maybe the October 22 stock market lows will hold, and that will just correct here and stay in a normalized range until we kind of see the light on the other side of the tunnel and come out of the recession. The market is in discounting mechanism in advance of the change. So if the market sees that the economy is now bottoming and getting better, market will start to take off. And that means the October 22 lows will hold. But if things get worse, then the market's going to reprice everything, and will probably break the October 22 lows. And so at this point, it's really anyone's guess. There could also be other geopolitical factors that come in to position and affect the economy. Inflation coming stronger and stronger could affect the economy. So we watch all these factors to see what's happening, and then we have a 4-star rate protection program for portfolios where we raise cash and partially or completely get out of the risk markets during big downturns like that. And we're already actually in position two, Chris, as we've talked about before on this show. There are 4 different moves to go from maximum invested, fully invested, to what we call maximum cash. And we've already had 2 signals and we've made those 2 moves. So we're halfway to getting fully into maximum cash levels. So hopefully that's where it ends and we don't have to go further and the markets bottom here and then start going up. But we'll take the protection that we need to if things get much worse. So,
yep, yeah. I mean, I think we're certainly seeing some short-term volatility. I think so. We've taken those protection measures there. So, but we'll see. I think you have a good point, Brian. I mean, we could have a recession, and it might, the market might just kind of, move up and down, kind of within a certain band. Maybe not have a dramatic fall off, and then we see that light at the end of the tunnel, as you say. So, we'll just have to kind of wait and see.
Yes. Well, and a couple other things that are affecting the economy here. We're seeing changes in the Medicare system, and of course, we talked about this on previous shows that the Medicare was used as a way to put people onto government assistance during the pandemic. Many people who would not normally be eligible for Medicare, but they rewrote some rules to give them an opportunity. Well, now in all states, they have been pulling people off Medicare and they have to go onto their own program. And then they might go to Medicaid if they don't have any other assistance, or they'll have to get into other programs. So we mentioned this earlier that this was happening. I think there were 70,000 people in our headquarters state of Illinois that were knocked off the Medicare rolls. And so that's an opportunity actually for people who are doing Medicare supplements and all kinds of different things. So big trends and changes there. Now, recently, Chris, we've seen some TV commercials. Hey, have you been dropped from Medicare? And, call this number and we'll help you out. And all those ads to get people onto different programs. So that is a real thing. It's happening in every state in the union. And so that's affecting the healthcare markets quite a bit with all these people being dropped from Medicare.
Yep. No, yeah, certainly. I mean, it's going to have an impact, on the healthcare industry, I would say as a whole. So it'll be interesting to see how it plays out, I think, for sure.
Yes. And another interesting trend we've been talking about for a while, we have all these companies that for years worked in China doing manufacturing, where they were getting lower cost wages through working with many of the millions and millions and millions, tens of millions of laborers in China who were leaving the rural areas, moving to the cities. There's been a great migration to the cities in China now because of this trend. But the current Chinese government is now getting very, very aggressive politically, and they're very controlling. Of course, they're not. There's no freedom there as far as freedom of speech. Capitalism is definitely controlled, so it's really much more communism than capitalism. While they like the fruits of capitalism, they don't want all the freedom of capitalism to flourish too much in their country. They prefer control over freedom. And so now, since the government's getting so aggressive, many companies are leaving China and they're bringing some of the manufacturing back to America. So we're seeing a little upsurge there, but more so they're moving to other countries like India, and then the ASEAN region, which is Thailand and Malaysia, Indonesia, places like that. So, that's a big trend and it's going to continue because, it's hard to do business in a country that basically is suppressing speech. And obviously there's lots of human rights abuses and all that other stuff. Politically, it's very sad, but just from an economic perspective, the companies are all leaving China so they don't get in trouble with the United States government. President Biden has put more sanctions on the Chinese government as well to restrict flows of trade and also flows of capital to China, as long as they're saber rattling and threatening America. So very interesting. Chris, you have some more on what we see out there area, don't you?
Yeah, I mean, the last thing I have, which I think is quite fascinating, is kind of in the political realm that you were talking about, Brian. But in the House, the Speaker, Kevin McCarthy, was ousted as speaker for and that's the first time that's ever happened in U.S. history. So, continues to be kind of a shakeup there in politics, and a lot of that was over the budget deficit or the budget talks that were happening, and then that was volatility. Obviously, they passed it, but I think it's important to note that it's very short term. I think the next time they'll have to kind of reconvene, if you will, is in November, mid to late November. So it's going to be here before you know it. There's so many different variables within this market right now that could swing it one way or the other. I think it's important to note. And if we did have a large government shutdown for an extended period, let's say a month, that would have a huge impact on the U.S. economy and could push us into a recession.
It could. Yeah, the turmoil in Congress could. I do think in another week they will be meeting. The Republicans have the majority in the House, and there'll be a meeting to elect probably one of two leaders. Either Steve Scalise, who's one of the leadership congressmen from Louisiana, or Jim Jordan, congressman from Ohio. Either one of those two gentlemen is most likely the speaker, and then they'll move on. But when you have a very small majority, it keeps a lid on what they're able to accomplish. They did solve some of the budget deficits. They did get rid of some of the COVID spending that wasn't needed because we were experiencing big time inflation. And that was part of the cause of it is a lot of the COVID spending. But then they weren't able to get everything done. And a certain small group of congressmen who wanted a lot more done were really angry at the speaker. Now, of course, the inside story there, of course, the former speaker, Nancy Pelosi, had said to the Kevin McCarthy, if you have trouble with your hardcore conservative ranks, I'll make sure you get enough votes to say speaker. But when it came down to it, the motion to vacate, she didn't do that. So then they immediately removed her from her office. She had a special private office as a former speaker, and they moved her out of that office. So there's lots of inside stories there about what was going on. We talk about it because it could create turmoil, Chris, as you say, for the economy. So if the House can't pass bills because they don't have a speaker, which of course they cannot, they have to have a speaker, then that just slows down any reforms and any other spending that needs to be there. It also could put millions of government workers out of work for a period of time. Now, usually when they do that and they have a shutdown, they then will rewrite the bills to go back and pay everybody for the back pay too. But then, of course, they got a vacation. They didn't have to work. That's, I guess that's how government works. But nonetheless, it's kind of a mess in the short run. But I think they'll eventually elect a new speaker in the next 5 to 10 days, and then everything will be back to normal. So it is an unusual thing, though. They've had motions to vacate the speaker in the past. Last one was, I believe, in 1910, but it didn't happen. So this is the first time a motion to vacate the speaker actually did pass. So it's kind of notable on a historical basis, Chris, as you. But hopefully there's not much effect from that. And there is a blog post on the Leadership Matrix, Chris, about this, and just reviewing the other blog posts. We also try to follow science and space and a lot of really interesting things that can long-term affect the economy. So we wrote a piece on hydrogen, and another update on hydrogen. That is, the hope for new energy. We've gone from fossil fuels now to electric, to solar, to wind, and those are still developing. But if hydrogen were to come in and it was self-generating, which they think they've been able to figure out if they can just find a way to make that on a much, much larger scale, hydrogen could trump all of these forms of energy, from fossil fuels, wind, solar, electric, all of it. So.
Yeah, no, for sure. I mean, I think that's, hydrogen and fusion, I think, are the two big ones, but, we'll just have to see. I mean, I think that there has to be obviously strides that need to be made on scaling it and everything as well. So, but the promise is there, and it seems to be they're making headway on it.
Yeah, they are. So, hey, I think that's all we have for today, right?
Yeah, I think that about wraps it up.
Well, great. Well, thanks everybody for being with us. We wanted to give you kind of a full update on the economy, what we're seeing. Just to kind of recap, markets are pretty rough right now in the short run. It hopefully is just a bad correction, but it could, if things got worse in the economy, it could get worse. So we're watching ever vigilant, ever closely. We're hopeful that it's a mild recession and the markets just kind of have this little breather and start going back up. But we're there to protect everybody who's working with 4-star, of course, if things turn south. So let's pray for America. Let's pray for a good economy. Let's pray for inflation to go down. And we'll be back, Chris, with another episode here in a couple weeks. We have a couple really interesting interview episodes coming up in the interim as well. So stay tuned and watch for your email. If you're getting this on email, if you're seeing this on the podcast series, look for the new podcasts as they come out on Apple iTunes, Stitcher, Spotify, and everywhere else. Let me also throw in a commercial. Please give us a 5 out of 5 ranking on Apple iTunes. The more 5 out of 5s we get, the more readership we get around the world. And we've now, of course, been heard on 7 continents. So we're proud of that, including Antarctica, believe it or not. We had one listener just off the coast of Antarctica. So anyway, I'm rambling here, Chris. Why don't we leave it there? Thanks, everybody, for being with us.